So my name is Glenn Gassen. I work for Espoo Marketing, and we help international corporates and players to engage with our ecosystem, and we help local players to be successful. Well, anyway, I will guide you through the next session, and without any further hesitation, I want to introduce our keynote speaker, Jyri Engeström, who is a co-founder and general partner of Yes VC, an early stage VC in San Francisco. He has a long experience in the Silicon Valley, but previously to that, he has founded companies like Yaiku that was acquired by Google, and Diton that was acquired by Groupon. He has been a speaker at Slush for many times, and he has worked for companies like Google and Nokia. But I want to give the mic to him, and he will tell us his view from an investor's point of view. Jyri, are you there? Okay, I'm waiting for Jyri to share the screen and start his keynote. Jyri will first deliver his keynote, but then we will also invite Tuula Antola from city of Espoo and Antti Vasara from VTT to join the discussion. And I'm really looking forward to have Jyri here to give his keynote, because I think it's really important that we also get a mirror to what we are doing here in our ecosystem. I mean, we are not alone in the universe, so this is a global ecosystem in the end of the day. So it's definitely important to get a point of view that is not necessarily really just our own. And I think that also an investor has of course a special approach to seeing what is happening here. So, okay, Jyri, please, the floor is yours.
And thank you. I was going to just give a few minutes on the venture capital perspective into startups. Since I started out my career as a founder and entrepreneur, and raised money from venture capitalists, both in Europe and in Silicon Valley for a couple of companies, but started to realize as I grew into first angel investing into other founders' companies, and then more later as a venture capital, as a professional fund manager, that entrepreneurs, surprisingly, don't really think about the business model of their investors. And because of this, over and over again, I would see these patterns where almost predictably over time, in some cases, not always, but sometimes, the interests would get misaligned and problems would occur. And so now, as for the last few years, I have worked as a professional investor, and not just as an angel investor, which typically means someone who is investing their own personal money into companies, but as a professional fund manager who invests other people's money. I also realized that there's a big difference between those two kinds of investors, and their business models look very different. And so in order to just, I think it would be helpful if we just took a few minutes and studied the business model of a venture capitalist, because it turns out that as a VC, entrepreneurs got entrepreneur, and I am an entrepreneur, and I find myself as a VC continuing to be an entrepreneur, but now my business model is different. And so I've prepared a few slides because it's a Zoom meeting. And I hope that you guys can see this, but I'm gonna present from my screen now. And then hopefully someone lets me know if you can't see this. So hopefully everyone can see. The title is What You Should Know About Venture Capital. And hopefully everyone sees this text. So let's start. I'm going to tell you a story first that occurred a few years ago, not that long ago. This is maybe 2016, I want to say. So we had, together with my partner, Katarina Fake, made an angel investment into, it was, at the time I was full-time running a small school, private school for our kids and our friends' kids. And someone I knew, an entrepreneur, founded a company, a startup for homeschoolers. And so we decided to invest as angels. And then a couple years passed and the founder came back and, on the call, you can imagine this call, I'm sort of, pretending to be this founder now. He says, "Are you sitting down, Jyri? I have great news for you." And so I'm like, "Ooh, what's up?" And he says, "There's an exit. We're going to sell the company, or in fact, we're doing a secondary round. There's a big new VC coming in, and you have an opportunity to sell for 5x your original investment." So I don't know, maybe we invested somewhere around $200K and maybe $200,000 in the company together. And so, let's say we made $1 million on this deal. So it seems great, right? So as an angel, you're like, well, 5x, what's not to like? Wonderful, and whatever, the deal got done. Now, since then, I've noticed that if the same founder were to call me and we'd have the same exact conversation as I am a professional fund manager, let's say that I had invested from a fund, and he says, "I've got great news. Are you sitting down, Jyri?" And I say, "Well, what's up?" And he says, "I've got a 5x exit. You're going to make your money back 5 times over." Why would I not be excited? It doesn't make any sense. But the reality is that I would look at that and I'd go, crap, that sucks. And now I'm going to explain to you why that is. And it's really important if you are an entrepreneur considering raising venture capital to understand why. Okay. So here I am. This is me a couple of years ago in 2018. Together with Katarina, I started a fund. It's called Yes VC. And so what was the conversation like? Well, first, what do you have to do when you start out as a VC? You take out your phone, right? And you text your friends. You say, "Hey, I'm starting a fund." Great. And obviously your friends are going to go, "Well, okay, but you got to make your money back at least market rate," which in VC is at minimum a 3x return, right? And now remember, VC funds, typical lifespan is 10 years. So we're talking over 10 years. So of course you say total, no problem, right? That's how it gets started. So you send a couple of these texts and lo and behold, you go to the bank, right? You've raised your fund. And now let's say it's a small fund. You're just starting out as a VC. It's a 50 million euro fund, right? A small VC fund, okay? Now, you've gotten all these friends to invest their cash into the fund, and they're all expecting the minimum market rate. So 3x in 10 years, right? So fund should eventually, that 50 million return 150, right? Better funds will do, early stage funds, 5x. We're in a fund that is at, I think, 133x now, right? So this is baseline. Basically, I will be out of a job if I can't deliver even 3x, okay? Okay, now let's roll forward. How does this 50 million actually get spent? Well, over 10 years, a part of that actually goes out in fees. And so roughly 20%, which sounds high, but when you start making the math, that's actually pretty standard. So now, all of a sudden, of that 50 million, I only have $40 million or euros left to actually invest as a VC into companies. Now, what happens to that 40 million? Well, in normal cases, almost all fund managers actually split their fund into 2 big chunks. One is the initial checks into new companies, and the other chunk is the follow-on checks that they plan to put in later to defend their ownership as those companies that are doing well raise more money. Okay, so in an early stage fund, like in our case, it's about 50-50. Normal, I think, average VC split is actually much less into initial checks and a larger portion reserved for these follow-on financings, often 2/3 or even more, okay? But we're very, very early stage. We're taking high risk here. So we'll say we'll do a 50-50 split, okay? So now remember that 40 million just got split into two. And now what's left of the 50 that I started with, only 20 million, I'm actually looking to invest into new companies, right? Potentially your company, right? One of you. Okay. Now, how am I going to decide what I do with this 20? Well, obviously I'm not going to invest all of it into one company, right? Because I'm a VC, I'm building a portfolio and I need to diversify my risk. So at minimum, an early stage VC would probably build a portfolio of, let's say, 20 companies at least. Some have 50, 40, 30, but 20 is, it's okay. It's easy for this exercise, right? So now I had 20 million. I'm splitting them on average into, of course, 1 million times 20. So each new check into a new company I write is going to on average, be about $1 million or €1 million. Okay. So now just to go over the math of what's happening here is, let's say one of you is pitching me. If you're an entrepreneur, you've got a new great idea. And, given the current situation in the market, how much am I going to buy of the company for my, on average, $1 million or €1 million investment? Well, on average, it's about 10%. So that means that the post-money valuation of the company will be, on average, 10 million euros after my investment, right? So let's say that I repeat this 20 times over. I build up my portfolio, typical investing period over 3 years, and I place these checks. I make 1 million to you, 1 million to you, 20 times, right? And now I own 10% of each of your companies. Okay. Now what happens? Well, of course, I'm expecting those companies to start doing something and hopefully their valuation to increase. Okay. And then let's say one of them is my friend who I started out with, this hypothetical scenario where there's that phone call. Are you sitting down, Jyri? I've got a great news for you. We're exiting at $50 million or euros. So now what it means is my 10% ownership at that exit value of 50 million returns 5 million euros back. Great, right? But now this is the crucial question. Why is this not great? Why is it not great for a venture capitalist to get that phone call? You just made 5 million euros. Well, this is why. Remember, I had this fund now. I wasn't just an angel investing my personal money. 5 million is only 3% of the expected return that I promised my limited partners, my investors, that I would be delivering to them after the fund is over, right? So that 50 million I raised, I've signed up to return 3x. So make 150 million return, of which, of course, the 5 million is only 3%. So I still need to find some other company. One of the 19 that are left in my portfolio now has to, or they together have to make up for that missing 145 million. But now here's the crucial point. I'm sure some of you have very much heard this before, the power law of venture capital, right? Which basically means that 97% of all of the exit profits comes from just a few companies. And if you then overlay that on top of my portfolio of those 20 companies that I had invested in, it's reasonable, if I'm a good VC, for me to expect that I would have one company maybe in there that returns pretty much all of that fund. And not just the fund 1x, but actually 3x. And so now, in reality, what I'm expecting is that every time I make a new investment, remember, every year I have to go in front of my LPs, actually every quarter, and tell them how my fund is doing and what new investments I've made, and basically defend why each and every time I wrote that $1 million initial check into a new company, I can say that there's a credible path for that company to become the one that returns the entire fund. So remember, I made $21 million investments. Each of those, when I'm considering whether I should invest in this company, I'm not thinking, is it going to make me back 5x? I'm actually thinking, is this the one that's going to make me back my fund 3x, which means 150x that $1 million. So if you translate that into what kind of exit valuation I need to see, that means if I invested, remember, I bought 10% of the company. Now, that 10% needs to turn into 10% of 1.5 billion of exit value in order for me to keep my job and be able to raise fund 2 after 3 years, right? So, and if you account for dilution, as you know, when new larger investors come in later, my early ownership from 10% is actually going to keep shrinking down. So potentially it'll be only 5% at exit, which means that 5% still has to be that 150 million euros, which is now 5% of $3 billion. So this is why when you're raising venture capital as an entrepreneur, a founder, it's really important that you understand what size of a fund does your venture capitalist have? What's their return expectation for that fund? Typical is minimum 3x. What does the portfolio look like? How many checks are they placing? Where do you sit in that portfolio? What are the other founders, other companies that VC has already funded from that portfolio? Is there a winner there already or not? Could you potentially be that one that they're expecting to make up that whole return? Very likely, yes. In fact, no VC should be investing into anything unless they expect that company to be the fund returner, because they don't know, right? If they don't even expect it to return the fund, they probably shouldn't have any business in investing in you. And that's why it's what seems from an entrepreneur's perspective to be a great outcome can be a total disappointment to a VC, right? And so it ends up, I know you can't see this, but this is just to give you an idea. This is a diagram I drew of our actual deal diligence process of how we diligence deal flow. And you can see it's total science, obviously. It's very scientific and precise. But as a venture capitalist, you're making a decision about whether to invest into a new founder, you'd have to consider those things, right? And you talk to people, you try to figure out like, how big could this get? What kind of slice of the company am I buying for my, let's say, €1 million? And then what's the likelihood that I'm going to end up, this company is going to have to end up raising a lot more money from other VCs later that may dilute me? And where does this leave me when I make my projections and calculations about how I'm actually going to be able to keep my job and return money to my investors 10 years from now? So something to think about. And I'm going to turn this back over, but wanted to share this with you because I think that the venture capitalist's own business model is oftentimes not very transparent to the founders and the entrepreneurs that pitch the venture capitalists. And it's important that you understand this so that you can consider whether it's aligned with where the venture capitalist wants you to go. Because as you realize, the VC is going to have tremendous interest in keeping their own job. They're going to want you to go in the direction that they need to see you go. And you're going to be stuck with them for the remainder of the life of that company. So if you aren't sure when you're pitching venture capitalists, remember to ask these questions from them and see how they answer. Because surprisingly, there are many VCs out there who also don't understand their own business model. So you should probably pick the one that does, and that can help you understand how you can be in alignment. Thank you. I'm going to leave it there.
Thank you, Jyri. That was very insightful. I think it's always super important to understand the people you are dealing with. And understanding the investors' business model is definitely something that startups should be able to do. I'd like to invite Antti Vasara, the President and CEO of VTT, Technical Research Center of Finland, to join us for a discussion. And as well, Tuula Antola from the city of Espoo, the Director for Economic Development. Antti and Tuula, are you there?
I'm here. Hi, Glenn.
Great to have you here with us. Tuula, are you there as well?
Yes, I'm here. Hello.
Great. So I'd like to maybe give a first question to Tuula. I think that Espoo has really a strong track record in innovation and growth for Finland, as Jyri Jokinen also described that what happens in Espoo is really important for whole Finland. And the last 10 years, they were not so easy actually for Espoo. There was a major company that had some problems. And on the other hand, we have seen a great startup boom coming out of Espoo. What does the city of Espoo to boost startups and the ecosystem, and why is that interesting for investors?
Yes, thanks, Glenn, and thanks, Jyri, for very exciting presentation. I have my background from Otaniemi, as Jyri had his hat, I do also, and I have actually 2 hats from the Otaniemi campus, so I'm more or less almost born and raised there. But I also have my own background in entrepreneurship, and wow, I wish I would have listened to you, Jyri, 10 years ago when I was pitching for VCs. But about Glenn's question, what the city has been doing or what we should do to enhance and boost the ecosystem of entrepreneurs, investors, academia, all of us together. I think when my boss, the mayor, mentioned about our city strategy, which we call as Espoo story, I think everything starts from there. It's a strategy of doing together. And from the perspective of our startup investor ecosystem, the role of the city, I think it's about enhancing serendipity of meetings, of prospects for VCs. And as Patrick earlier said, you talked about radical zebras, but I think these radical zebras are not enough for Jyri and other VCs to reach your goals. You really need the unicorns. And the role of the city is creating a platform for the potential unicorns to be born. And what we do for that, I think that we consider city as a test bed and platform for services, new products. And our role is definitely it's opening for all the potential and possible public data we have. But we have to be responsible pioneers also related to opening data. And that's one of the reasons why I have been one of the founding partners of the Finnish Center for Artificial Intelligence, for example. And I think that this FKITES and one example of the ecosystems and other ecosystems to be mentioned, for example, Smart Otaniemi, related to smart and sustainable future energies, European Space Agency's space technology ecosystem, Health Capital Helsinki, to mention a few, where we as a city have been also active from the beginning, together with, for example, Aalto, VTT, corporations and companies. And finally, I would like to mention also the importance of the strong commitment on sustainability. And SDGs were mentioned earlier, and I'm really happy also for seeing more and more startups coming with a passion for impact, not only for the fast exit. And I think that has been the change we have seen on Slush also within the last few years. And again, also for those companies interested especially on impact, I think the city is it's a match made in heaven, a good partner for testing and piloting first solutions for the local challenges, local problems even, and then scaling up them to the world together with Jyri and other VCs, for example. And finally, I would like to mention also our business services network called Business Espoo at Acrid, where Glenn seems to be at the moment at Mordor Auditorium.
Virtually, yes.
Yes. And so we have all of our services, city services for entrepreneurs and companies under one roof there, next to Marikka Paakkala's team, Aalto Startup Center, next to United Nations Innovation Technology Labs, ESAPIC, and others. So I think the city should be there where the people are, where the ideas are, where the innovations born. So I think that's our role, not to run our own accelerator, but to act as an accelerator of accelerators.
Thank you, Tuula. And well, I think not by incident, almost all Finnish unicorns have been born in Espoo. That's a good track record so far. I'd like to ask Antti. VTT is basically one of the main drivers for deep tech in Finland. When you have a closer look at Finnish deep tech startups, well, quite many of them have a background in VTT, and of course VTT has a strong excellence in technology and applied research. But Antti, what do you do to boost startups and the ecosystem? What do you do to make the next unicorns be born?
Thanks, and thanks to Jyri, first of all, for a super clear presentation. And regardless of topic, I wish we could all explain things as lucidly and understandably. But what do we do at VTT for startups? So there are sort of two paths here. So number one is then that we of course work with existing startups. We do research in many areas. We have research infrastructure that's available to others for using. And despite what people think, usually people think then that startups are so small, so they do their own thing. But we at least encounter a lot of startups that have super ambitious competence. They are looking for research partners, and then we are then working together with them to help pursue their goals. Sadly, most of the times the startups that we work with, really ambitious goals, are the ones who come from outside Finland. So in a sense then, that as a testament then that we're working on interesting things, it's good to have California companies contacting us, but of course we would like to see more deep tech startups in Finland who would have similar type of ambition level and willingness then to really invest into deep tech. For that point then, as Glenn also mentioned then, that we are also then spinning off starting companies at VTT, or our researchers are starting them up. So what we try to do there, first of all, we hire people who are good at science, good at technology. We try to groom and nurture them while they're working at VTT so that they can develop their skills and all the time become better and better. And then a portion of them then get the entrepreneurial fire burning inside them, so that they then at some stage they decide that they want to become entrepreneurs. And there's of course been people who have just left VTT and started up their companies, or just basically found a different way. But these days we also try to help them make that transition from being a researcher to being an entrepreneur. So, and as I'm sure that many people who have done the jump have noticed then that being an excellent researcher is, of course, it's by no means enough. So, we set up last year a thing called VTT Launchpad, our own incubator. Lotta Partanen, who runs it, I noticed that she's online, so she's also here in this Zoom. So Launchpad's purpose is then that we would, for those people who have the burn to set up their company, we'll help them fine-tune their business case. We introduce them to other people who could become co-founders, people with entrepreneurial background or business background, or sort of these complementary skills that the researcher doesn't necessarily have, and introduce them to investors, VCs. And with the idea then that once they have been through that incubation process at Launchpad, they would be much more ready then to face the outside world, and you could put them on a good trajectory that at least the start for their entrepreneurial career would be as good as possible. And of course, after that, it's up to them. The third thing that on this front we've been then working on is then that, of course, we try to introduce the wannabe entrepreneurs coming from VTT then to investors from all over the world. We used to have a VTT Ventures, a subsidiary at VTT that was kind of like doing those introductions. Now we are sunsetting then the Ventures organization, so we just basically maintain the current portfolio and do the exits from there. But then we were lead investor, lead LP then in a new VC fund, Voima Ventures, that Inka Mero and start with the idea then that it's much better than to have a deep tech focused VC fund that's professionally run, and they're also investing into other deep tech startups that not only VTT originated, although they actually don't have they don't need to invest in VTT startups at all, so they can choose where they invest, but they have been very good at also helping sparring some of the wannabe entrepreneurs. But also then, of course, other VC funds that are working in the deep tech field. Lifeline might be, for example, have been very, very good at sparring. But that's also important then that there are these deep tech venture funds close by, because that makes it easier then for the companies to find funding as well.
Antti, I'd like to ask you something I'm super excited about. It was already mentioned that VTT has received 20 million funding for building Finland's first quantum computer that will be here in Espoo. Can you tell us more about this, and what do you foresee as the main application areas?
So yeah, the quantum computer is of course something that we're really excited about. So the 20 million there is for acquiring and partially VTT doing also the work. So the idea or the purpose why we're doing this is that we think that quantum computing is one of the most promising areas in technology for future years and decades. So it's like inventing transistor or microchips. So Lord knows what will come out of that. And we want to be early on in there. And the main interest is you could say that the main interest is not to have a quantum computer. The main interest is to understand that how to build one, what type of technologies are needed, and use that as a platform or substrate then that companies can be born that are then creating components or parts of the software stack or these types of things. So hopefully this will be a start of the quantum industry in Finland. So then that there will be companies that are created. There will be people coming from abroad because they can then get access to a quantum computer, or they can offer their solutions there and want to be in the community or the ecosystem building stuff here. And also then in the sense that we'll start understanding how to build the algorithms and these kinds of things. And eventually I'm sure that the machines be so that they can be used for things that classes can't. And I'm sure that there will be lots of things around materials research, materials simulation that will be among the early applications. Probably something also around quantum internet and the cryptography and those areas. But like the people who built the first microchip, I bet that they didn't invent or kind of like imagine Zoom or Netflix or the Ponce forest machines and those kinds of things that would utilize these technologies. So whatever I can imagine here is probably be laughable in a decade's time, but then at the same time, the stuff that people will imagine out of this will be just amazing and things. Then we will, hopefully there will be people remembering then that VTT at least had a small part in being initiating some of these things.
Yes. We are a little bit behind the schedule, but I was given some additional minutes. I'd like to ask Jyri, now that you have heard from Tuula and Antti, what is happening here for the next for the near future? How does that sound to you? I mean, is that something that makes sense for an investor that raises interest for this ecosystem? And do you maybe have some ideas what needs to be done to basically enter the next level and evolve as an ecosystem?
Yeah, I think that first of all, it was really great to hear from both of you. Thank you. You know, someone recently, and I think this is probably a particularly Finnish comparison, said, well, the Silicon Valley is kind of like the NHL of startups, whereas Finland presumably then is somehow smaller, I guess. And I've heard this so many times now from Finns who tell that to me, this comparison, that I actually went and I did the homework of the numbers and it turns out the NHL has, I think, 32 teams of hockey players, right? That together are valued at about $20 billion, right? And then, you know, just the 3 largest companies in the Valley right now, it's like if you take, I don't know, Apple, Google, and Facebook are valued at over $3 trillion together. So there's this sense of, I think it's very hard to sort of understand the scale difference. And I think it's really important for when we're talking about entrepreneurial ecosystem to realize that to be able to kind of understand those scale differences, right? Because it turns out that basically you can fit the NHL into Silicon Valley so many hundreds of times that it's ridiculous. The comparison is it kind of ignores that. And what that means is that when, you know, Tuula city like Espoo or VTT invests into innovation, they kind of have to, just like I as a VC, look for the things that are able to return the investment on that kind of scale. And so talking about like deep tech or quantum computing is a really good example, because there the understanding is that if you work on that, that potentially has that kind of power law sort of return, right? It's not going to be NHL, it'll be Silicon Valley. And in order for, and this is challenging, right? Because it skews you very much. It's such a tiny slice of things that have that potential, that if you only focus on that, you're going to ignore 99% of everything that's interesting in the world. And yet, this is the dilemma of internet capitalism, right? Is that if you choose to ignore it, then you're less likely to hit the mark. And I'm just going to leave it there, but I really think it's important to understand that there's a very important difference in VC or the Valley kind of focus. And I think that you need to sort of overtly acknowledge that. And then there's different kinds of financing instruments. There's different kinds, and I'm not saying one is better than the other, but I frequently feel like in Finland right now, we're mixing the bag. And a lot of the stuff, I would say a majority of the startups that are in this bag that is presented as being about startups does not fit. Like out of the, I think we've made like 19 investments out of this fund so far. 0 are into Finnish companies, even though I have this huge interest in investing into Finnish companies. And I think the reason is that most of the stuff that is presented doesn't fit that criteria, right? And so I think we need a broader set of instruments, not just talk about VC, and acknowledge that there's this very specific kind of return profile for the things that actually are investable from like a, I don't know, like a Silicon Valley perspective. And of course, most of those in Finland tend to be gaming companies, which is super sad, but that's just the way it is right now. So we need to also broaden into things like deep tech in order to generate more, I don't know, uros type things, and hopefully also things that actually are community movements, which is what we really are interested in.
Mm-hmm. Yeah, thank you, Jyri. We are running out of time now. Thanks again to all speakers, and I hand over to Kari.